On today's Hot Sheet, I'm discussing the surge in multifamily supply, the Redfin Home Price Index, and mortgage applications. Today is Wednesday, February 21st, 2024. I am Byron Lazine, and the Hot Sheet starts now. Welcome into today's Hot Sheet, the 24-hour look back on housing each and every single day that the market is open, except for Fridays, of course. Let me know which market you're tuning in live from today. All right, let's jump right into what I have been calling now for this entire time we've been doing the Hot Sheet. For those of you that have been following since the beginning, which is last January of 23, you know I've been saying this is going to hit. And it was expected to hit in the fourth quarter of 23. A lot of it did. And now there's even more hitting this year and into next year. And that's the supply of multifamily apartments. The wave of multifamily supply is coming this year, the big wave. Lance fell short of calling it a tsunami, but maybe I would consider it a mini tsunami. And we're going to go through the housing markets that will see the most. John Burns Consulting says, while 2024 and 2025 should be the busiest years on record for new apartment construction and deliveries, the pipeline will then thin out. And that's due to what we're seeing now on permits. Because a lot of these developers are saying, whoa, some of these markets are going to soften. Somebody CC Jerome Powell on the message. These markets are going, these rents are going to soften. In many markets, they already have. We've been talking about this. There are a lot of markets where rents have come down, and expect rents to not only decelerate in 24, but in many areas, some of these areas that we're talking about here, where the wave of supply of multifamily apartment housing supply that's coming on, rents will come down even more. Why do we like that? For those of us that are looking for the 30-year fixed to get some relief, why do we want rents to come down? Okay, because it's going to pull inflation down further. We've had a couple hot reads on inflation recently. I think if we're tracking reality of the rental market, then you'd see inflation even lower. Logan Motoshami on Friday, when we had him on Knowledge Brokers podcast, he referenced inflation pulling shelter out below the 2% target. Got into that a little bit. We've talked about that here. This pipeline of apartment housing is one of those things that's going to help. It also, in a world, and maybe some don't want to hear this, certainly real estate agents, in a world where housing has become more unaffordable for many, apartment housing prices coming down gives them an option. It's the option that Jerome Powell prefers. Remember, the government doesn't care about home ownership, specifically the Fed. They care about stabilizing prices in the now and maximizing employment. Okay. So if we can get shelter to come down on inflation, we can get closer to those cuts that we want. We can get closer to that 30-year fixed coming down. All right, let's take a look at the 10 markets published by, this is research published recently by John Burns and Consulting. If we take a look at the top 10 markets that have the biggest multifamily unit pipelines coming on, here they are 1 through 10. Dallas coming in at number 1, 55,000 plus units. These are units this year. Okay, so these are the units for multifamily coming on in 2024. New York has 53,000 plus. Phoenix has 51,000 plus. Austin, which is already, already seen deceleration of home prices, already has seen inventory go up more than many other markets, coming in at 40,000 plus multifamily units in 2024. For all of these markets in particular, this is good news for what will happen with prices. Okay. What'll happen is as there's these opportunities to get a rent for a lower price or maybe 2 months off. It's like you're going to see some people say, "Hey, I'm going to go do the 1-year rent," that are maybe in between, maybe leaning more towards rental anyway. The value is going to be so good they go over there. You'll start to see days on market in these markets like you have in Austin already because they've already seen an apartment surge. You'll start to see days on market tick up, and that's where the serious sellers will have to tick down on their pricing, making it a little bit more affordable for buyers. At the same time, if you get a lowering interest rate, then they get a big, windfall of affordability in comparison to what they've had. Newark is at 5 with 38, almost 39,000 multifamily units coming in 24. Atlanta, 34,000 plus coming in 24. Charlotte, Houston, Washington, D.C., and Denver make out the top 10. John Burns Consulting says it's no surprise that the Sun Belt, the epicenter of U.S. population growth, has the most apartment supply coming online. You do have New York, obviously Newark mixed in there, Washington D.C. and Denver, but then the Sun Belt is making up 60% of the top 10. Let's take a deeper look here on the last 12 months for deliveries in comparison to what's coming. This will tell the story, especially if you're in one of those markets where you're like, we've had a lot of an apartment supply come on. If Austin feels like you've had a lot of apartment supply coming on, just wait until you see what's happening this year. Austin had 17,000 deliveries of apartments in the last 12 months, 43,000 this year. If it felt like you had a lot of apartment supply in the last 12 months at 20,000, the 55,000 is going to be almost a triple up in 24. Phoenix, 17,000 last 12 months, again over 50,000. New York only had 10,000 new apartments come into the city in the last 12 months. We're 5xing that here in 24. Atlanta, a little less of a jump there. You've got 20,000 to 34,000 this year. Houston, 20,000 to 30,000, incremental increase. Newark, almost a quadruple up for Newark, 11,000 to 39,000. Charlotte going from 14,000 to 33,000. DC is basically a double up, 14,000 to 29,000. Denver's a triple up, 9,000 to 30,000. LA, here's some of the other ones that weren't in the top 10. LA, 10,000 to 26. Raleigh, 11,000 to 24. All of these major metros are experiencing dramatically more multifamily apartment housing, apartment units in particular, that's the number we're going over here, than they saw in the last 12 months. Nashville's a double up. Miami's almost 4x. Seattle's near 5x, like a 4.5x on Seattle. Orlando's a double up. Philly's a double up. San Antonio's almost a 3x. I would call that like a maybe 2.7x. Fort Worth, 9,000 to 14,000. Tampa's damn near a triple up. Minneapolis, slight increase, 10,000 to 11,000. So kind of flat for Minneapolis. Boston, 7,000 to 14,000 plus. Salt Lake from 8.6 to 12.8. Jacksonville, which has had a bunch of multifamily apartment recently, goes from 7.6 to 13.2. So continuing to build in Jacksonville and continuing to come online. Chicago, 7.4 to 11.2. Columbus, 6.4 to 12K. Lauderdale, 13K this year. You can see they're like less than 5,000 last year, now 13K. Indy, Vegas, San Diego, Portland, Kansas City, Richmond, San Bernardino, all experiencing way more apartment housing than they did last year. I mean, these are major metros across the country. And they're all experiencing the same thing. Dramatically more apartment housing units in 24, the most we've ever seen come online in 24 and in 25. If you've been following the Hush for a while, you know this is going to start coming in the end of 23, and it did. And now it's going to speed up. It's going to accelerate through this year. This will bring rental prices down. If you're an investor who has a 4-family, they're really apartments, right? I think single family rentals are a category of their own when you go long-term single-family rentals, that's a particular product that some people want, a lot of people want. But when you look at apartments, okay, I'm gonna go rent an apartment. I'm gonna look at one of these new buildings in Dallas, which will have all the amenities, the pool, maybe pickleball, a nice gym, maybe a community center. A lot of amenities in these new buildings. A lot of these units coming online are gonna feel like a fancy hotel. They're gonna have great amenities. And so for the investors that are buying it at these interest rates, a 4 unit, a 3 unit, and they got apartments, be a great operator. If you're advising an investor or you're an investor yourself, you're going to have to be a great operator in these markets to compete with these units, unless you just want to compete on price and not make any money for the next 5 years. Some people are going to buy apartments right now and not make any money for the next 5 years. A lot of people who are advising investors, early investors, first time investors who think they're going to have cash flow in the first 5 years, help them understand you don't start making money till closer to year 10. Okay. Oh, well, I got $250 of cash flow right off the rip. I bought a 3 family. I bought a 4 family. I'm making $250 over the rent every month. No, you're not. No, you're not. You're putting those in reserves, and something's gonna blow in the next 24 months, and you're gonna blow all the reserves plus some. Okay, so you're not getting cash flow. $250 a month is not cash flow. That is a reserve that you're starting to build. And when the HVAC blows, okay, now you've gone through all of that and you've reached into your pocket. You're not going to start really doing something until year 10. You've got some kind of a refinance in those 10 years. Rents have gone up over a 10-year period. They're going down this year in these metros. They've gone up over a 10-year period, though, because they always do. And now you're getting maybe some serious maybe 800, 900, 1,000 a month. You have a reserve account. You figured out how to manage the deal. Okay. There's a lack of education coming from the real estate agent community into investors, early on investors, small time investors on 2 and 3 units. And 4 units. I'd be very cautious doing an apartment deal right now in Austin or in Dallas or in any of these markets that we just went over, where you're seeing all of this new product come online. I got to be a great operator. I got to have these things fixed up. I got to have something that they don't. Maybe it's, a great parking situation. Maybe it's a walkability factor. I better be accessible, self-managing, on top of things. Somebody people couldn't imagine not having in their corner. Those are the things that are going to make the difference, unless you just want to cut price down and lose money. John Burns Consulting also reported on year-over-year change in multifamily permits. So this building, this surge of apartments is going to start to slow down, because the smart developers are seeing this. Like, we've built too many apartment housings in a lot of these markets, the most we've ever seen on record. Unless we want to become a renter nation and just go that direction. I think Jerome Powell doesn't care either way. He might put in a vote for that. Miami, San Diego, San Jose, and Charlotte have gone the other way. They're jacking up permits. So they're still seeing huge opportunity in those markets. I tend to not disagree in Charlotte. Maybe Miami. That seems like a big number in Miami with all the building that's going on there, but the city continues to grow. Charlotte, not really worried about. That's going to continue to grow for 15 years. And then you see everybody else is going the other way. Okay. So San Francisco, Seattle, DC, San Antonio, New York, they're all down about 40%. Okay. So this is the change in year over year multifamily permits. So future built, these things take 3 years. Fort Worth is down. Boston is down. Orlando's down. Atlanta's down. Tampa's down. Tampa, they've built a ton in as well. All right. This is good news. I consider this all good news. I do think rents coming down is good news. I know if you're holding apartments right now, you're like, it's not. But for those that are looking for a 30-year fix to come down, to get home ownership more affordable for more, having rents come down is good news. Having this supply hit the market, and this will help inflation. It's good news for those factors. Okay, yesterday we went through a monthly update from Zillow. Today we have Redfin. Redfin Home Price Index is out, and they have said price growth is holding steady to start the year. Home prices rose 0.5% month over month in January, on par with December's gain. As drop in mortgage rates at the end of last year gave buyers a bit more purchasing power, that has changed in a big way. We're going to get to mortgage demand here in a second. Okay. All the charts, by the way, that we just went over on the multifamily stuff, as well as these, will be available inside of BAMX for you. I think you can still use code POTUS to get 20% off right now. If you can't, just email me, byron@nowbam.com, if that doesn't work for you. But you should be able to get 20% off using POTUS, I think, through the end of the week. I think it's still active right now. So we'll take a look. But POTUS to get 20% off of BAMX. Get the most out of BAM, of course. So price is up and to the right, of course. Month over month, we're up the half a point. Redfin senior economist says price growth held steady last month because many of the home purchases that closed in January were negotiated at the end of last year. So that's when mortgages posted the biggest drop since 2008. The end of last year, after peaking out at 8%, they dropped down. The decline in rate gives buyers more purchasing power that came into the market. That's why we did see to the point there, we did see a pretty strong market. Here are some of the metros here, the 50 most populous U.S. metros, according to Redfin. Anaheim, month over month change 0.4%. Let's see who had the biggest month over month changes. Charlotte had the biggest drop at 0.7% down. Austin, 0.6% down. San Diego, 0.6%, 0.5% down. Sacramento, 0.4% down. If we look at biggest change month over month, Montgomery County, Pennsylvania, 3.7% up. See, Zillow had and Hartford, Connecticut at like 12%. I don't see them. Almost. This is 50 most populous, so that wouldn't be in there. Okay. Baltimore at 1.9%, Philly at 1.9%, Cleveland 1.7%, New York at 1.6%, Milwaukee at 1.5%. Big year over year changes for the most populous areas, according to Redfin. Cincinnati, Newark, San Jose, Cleveland, New Brunswick. See, Newark coming in at 15.8% year over year. That multifamily supply that we just saw in the previous segment, that's going to be a welcome sign to a lot of people looking for affordability in Newark, that they had a 16% pop in home values year over year. Philly, Chicago, New York, Providence, Montgomery County, Charlotte, Anaheim, Boston, all 10% plus. Kansas City, Pittsburgh, basically there as well. The biggest drops, again, Austin, 5.3% down. San Antonio, 2.8%. Portland, Houston, Tampa make up the, Portland, Houston, Tampa, to their credit, were in the positives, 2.3%, 2.4%, 2.5%. San Antonio and Austin, the only ones in the negative, according to Redfin, on year over year home price values. Now, I gave you the good news. Here's the reality of where we're at right now with the rates. Mortgage demand takes a massive hit as interest rates cross back over 7%. Let's go to Mortgage Banker Association and get the real sauce from them. Mortgage applications decreased 10.6% from a week earlier. Remember, those are all applications. That includes refi. The market composite index, measure of mortgage loan application, decreased 10.6%. That's everything. On an unadjusted basis, index decreased 8% compared with the previous week. The refinance decreased 11%. That makes sense. It was 0.1% higher than the same week a year ago. Flat. Okay. This is the one I care about here. The seasonally adjusted purchase index decreased 10% from 1 week earlier. That is a reality we're faced with. Hey, we've got far less demand right now than we did last year, in a time when you want to see demand going up, heading into the spring market. The unadjusted purchase index decreased 6% with the previous week, and this is 13% than the same week a year ago. So getting back up over 7% was not good. We want to see that 10-year obviously stay below that 4.375 that we talked about yesterday, we're sitting here at 2.26, or I'm sorry, 4.263. So we're dangerously close. We're up above the 4.250, but we know last year when it went up, basically broke through 435, 4375, and it continued to go up to 5, and that's when we saw 8% rates. If we're seeing this slowdown in demand at plus 7% rates, and we already felt 8% at the end of last year, we know what that would do to demand coming into a spring market when demand typically goes up. So I am cautioning everybody to get 5% as if it's a guarantee this year out of the vocabulary. And even if we see a 5 handle, it's more likely to be high 5s closer to 6 than it is low 5s. 30-year fix yesterday, still comfortably up over 7, coming in at 7.11. And in the week last week at 7.14. So just a tick down yesterday. We'll see where it goes today. All right. That's your hot sheet here today. Of course, we'll be back tomorrow, as we are every Monday through Thursday that the markets are open, to take a 24-hour look back on housing, the only live housing show on the internet that goes daily. We'll see you back here tomorrow at 9:30 on the East, 6:30 on the West. You know the deal in between. And until then, toodaloo.